Good evening from ENCA's Money Desk. Now, the insurer Old Mutual released their latest results for the 6 months to end June today. Let's talk to the CEO, Ian Williamson, for more on this. Thank you so much for joining us, Ian. Tell us about the growth in sales, but profits were hit overall. What were some of the green shoots and challenges?
Evening, Melissa. Thanks for having me. We had fantastic new business sales growth really across all of our businesses. So ranging from 7% growth in our corporate business up to 18% in our mass and foundation cluster, 18% across the countries that we serve north of South Africa. And we saw our margins expand as well. So overall, our value of new business, which is a measure of volume and margin, went up by 32% in the period. From a challenges perspective, the key issue is really that consumers are under a lot of pressure. And we see that coming out in two places. One is in what we call persistency, which is the percentage of customers that continue to pay their premiums every month, month in and month out. We see pressure there primarily in the core mass market arena where people are on fixed incomes and suffering under the ravages of food inflation, transport costs, higher interest rates. And then as you move up into the wealthier sector of the retail market, we're seeing cash withdrawals from savings and investment products where people are seeking to either meet some necessary expenditure or maintain their lifestyle. And then on the corporate and institutional side, we've seen some quite significant withdrawals also from investment accounts, from companies seeking liquidity or seeking capital for their business, or really just seeking to shore up cash flow.
That is quite concerning. If we just go quickly back to your financial results, the interim profit would have grown were it not for its operations in Zimbabwe that are affected by hyperinflation. How will you mitigate this?
For some reason, across the board, the media seems to have picked up on the issue regarding our Zimbabwe business. If you look at the adjustment that we made for Zimbabwe last year and the adjustment we made this year, it's more or less the same number, so it's not really having an impact. I think it's important to explain that we treat our Zimbabwe business very much as a ring-fenced entity because there's no fungibility between the Zimbabwean economy and our shareholder base in South Africa. We can't really get dividends out of Zimbabwe at the moment. So we've ring-fenced that business for the last 3 or 4 years, partly because of hyperinflation, but mainly because there's no fungibility of capital between Zimbabwe and other countries. So you can think about it as we're a shareholder in that business. We treat it almost as an investment where we need to, from a moral perspective, look after customers in Zimbabwe, protect our brand, run the business properly. But we don't report it in our adjusted headline earnings because we don't consolidate that result into our group. And we don't think about it as a part of the group that influences our cash flow because there is no cash flow that comes out to support dividends or to do anything with. So you can think about it almost as something which we carry on our balance sheet at a nominal value. And if things one day go very well in Zimbabwe, we will see some good upside, but there's not really much downside to that from a shareholder perspective. So the right line to look at in our income statement is what we refer to as the adjusted headline earnings. That was up 23%. And we declared a dividend of 32 cents a share, which is up 28% on the prior year. And as I say, that's a reflection of what we see as the real earnings trajectory in the business, as well as the cash generation across our businesses.
Thank you so much for that clarification, Ian. Now let's go back to the consumer. And you've indicated that the challenging operating environment is set to continue. If we look at your iWise business, what trends have you been seeing there specifically related to load shedding and to floods that we've had now in the Western Cape? How are consumers navigating this, and are you planning on maybe changing some policies with climate-related risks?
Yeah, so across our short-term insurance business, so that's your house, your car, those sort of things, we have seen higher particularly weather-related claims in the first 6 months of this year, as you've alluded to. And load shedding has had an impact because what's happening is that there's quite a lot of appliance damage from power surges. So we've seen customers claiming significantly more, actually less this year than last year, interestingly, possibly because, load shedding's become such a regular feature. So power surge damage doesn't seem to have been as bad very recently, but certainly the weather issue is a much bigger one. Mm-hmm. So what we are doing, and this is a global issue, the reinsurers around the world have all put up their prices quite significantly for catastrophe cover, which is the sort of cover where insurers lay off part of their exposure into a global market for large weather-related events, large fire events, and things that are just too big to carry on an individual insurer's balance sheet. So you've seen those prices go up, and as a consequence, we've seen prices in the insurance market generally go up to cover that cost. I think for the long term, climate change and the associated volatility in weather patterns is a concern. We have a very skilled team doing a large amount of work on modeling the potential outcomes that could emerge over very long periods of time, of up to 50 and 100 years, as a consequence of climate volatility, and having a look at how we should be thinking about pricing, either from a geographic, geolocation perspective in terms of things like flood risk and fire risk and what have you, and looking at even the consequences for long-term insurability of such assets in vulnerable areas. I don't think it's an immediate issue, as it were, but I think over time we will see sophistication of modeling and sophistication of pricing start to increase, and much more refined thinking around what are high-risk areas and what are low-risk areas, and differential pricing between them.
Thank you so much, Ian. That was Old Mutual CEO Ian Williamson.